Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. In these updates, we talk about the news that affects the market and then put it in perspective using our Elliott Wave charts. In this video, we'll be featuring the stocks that you see on your screen now. And remember, if there's a particular stock you want to look at, you can click right to it on the chapters feature in the video. All right, let's get started. At the time of this recording, it is late on Friday evening, so the futures market is closed. If you like these videos, please remember to hit that like button, or better yet, hit subscribe, and you'll be notified immediately when one of these videos is posted. We really do appreciate it. All right, taking a look at the charts, you can see the market gapped to the downside today, moving down ever so close to those June lows. When you look at the volume, solid above average volumes. We have to pay attention to that. Well, when we look at the Elliott Wave chart, we know that the wave 5 was at the bottom there at that June low. Then you're supposed to retrace back to the previous 4. Well, we did that, and so when that happens, where do you go from here? You look for a new impulse move, and we've been highlighting this zigzag pattern to the downside, and look what happened today. We hit that 368 level. We've been talking about this for a number of days and a couple of weeks. In our shorts, we've been talking about it every single day, and here we are. We made it to that 100% extension. Now what happens? Where do we go from here? Well, when a zigzag pattern is satisfied, meaning it hit the 100% extension based on a 50% B-wave correction, you look to see what are the odds that it goes down to an extended C wave, which would be all the way down to the 161.8% level. Do we go down there? Well, we like to look at our confirming indicators. And when we look at our confirming indicator, you say, wow, on the DMI, that looks pretty strong. That DMI is telling you that there's strength to this move and it's likely to continue. But the DMI is a little more of a lagging indicator. So we also like to look at the CCI, which is more short term, and now we're seeing that the CCI is kind of at an extreme point low, which means at least for the short term, we are a bit oversold and maybe setting up for a potential just at least short-term bounce. There's the 10-day moving average, and you can see that there is some separation there, and with that gap, perhaps at the beginning of next week, we get a little bit of a bounce back to the upside. But is that going to hold, or are we going to move down to the 161.8% extension? Let me show you the VIX, and then I got a question for you. All right, when we take a look at the VIX, you can see that we did get above 30, finally. We had hit 30 a couple days ago, but we finally broke above 30, but we're not even to 35. Is that enough? As we're testing the June bottom, is that enough to put in a double bottom to have a VIX just above 30? So I would like to know your opinion. Do we go down and hit this 161.8% extension, or do you think we're done? Double bottoms in, we're oversold, we're ready to take off and rally. Love to know what your thoughts are. In my opinion, the bond market is screaming. It's not just flashing warning signs, it's screaming. Be careful. Panic. We're looking at a significant recession. The 10 years continuing to move to the upside. The 30-year hit 6.7%. Imagine what's going to happen with all the people out there that have adjustable rate mortgages when their next mortgage comes in after the adjustment period. So we're looking at this. We look at the 10-day moving average. We're not that much overbought. But when we bring in the yield curve, this is the thing to me that even the most hardened bulls in the market are having a real hard time with this striking inversion in the yield curve. There's the 2-year there above 4%, and then there's the 10s there. Most people look at 2s and 10s for the signs of a recession. This is going to kind of work against the market, in my opinion, the equities market, because now you can get over 4% on a 2-year, so you can lock in a bond or treasury at a better than 4% return, and then you don't have to take in the risk of the equities market. See, I think money is going to start to move into the bond market, and where's it going to come from? It's going to come from the equities market, which means moving forward is going to be difficult. I do think we get a short-term bounce, but after that, who knows? And we look at the dollar, and we've been trading within this wave 5 range for quite some time, but we've also showed you this zigzag pattern where we said the dollar was likely to go up to 112. Well, it went right up and even through 112 today. Does it go to 161.8% extension? Boy, we don't want to see that in the dollar. It's just too difficult on international companies with the exchange rate. So a strong dollar is good, but it's too strong. You've heard me say that before. Don't like it to get that strong. Some stocks of interest, looking at Tesla. Tuesday night during our TradeFinder, we're back over here, so we walk it back a couple days. You can see that we were here and people were asking, where do we go? Does Tesla make it up to that wave 5? Can it break above these levels? And I shared that my mentor used to talk about the third time's the charm, meaning when you had a test of a resistance level, support level, whatever, the third time, whatever happens from there is what tends to be the directional move for a while. And so that's exactly what happened with Tesla. We couldn't get above that wave 3 high. We tested it for the third time, heading lower, and we've moved lower significantly, breaking below the 50-day moving average today. So can Tesla hold this level right here at 260, which is where it seems destined to go? Maybe a short-term bounce, but we'll see from there. And by the way, if you haven't signed up for TradeFinder yet, do it. You can do it in this video and go to our website, ewotrader.com. It's free. Every Tuesday night at 9 p.m. Eastern Time, we talk the markets, we look for trade ideas, and we have a live Q&A. It's a lot of fun. Love to have you. Please sign up if you haven't already. Other stocks of interest this week, AMC. Now AMC is moving back down here, and it looks like we are set up to move back down to test that support at 7. We could even talk about going lower on AMC all the way back down into where it was before, but I don't think we break these levels. I don't think we break 5, and the reason for that is because when we had this meme mania in AMC and we had these big spikes to the upside, the management was able to raise a bunch of money, so their balance sheet looks better, even though the business model is still in doubt for the long term, but at least for the short term, they have cash, they have the ability to support the business and perhaps even get through this recession. We'll see. I just don't see it going below 7, but if it does, watch out below. Apple. We talked about that Tuesday night in TradeFinder as well, and we said that we need to hold this 150 level on Apple. Well, here we are right here, and the wave 4 is right around that 61.8% fib retracement level. If we don't hold this, then we're probably coming down at least to this next area of support right here in the 140 range, and it wouldn't be out of the question. I know it doesn't seem possible, but it wouldn't be out of the question to test those lows at 130. How Apple handles 150 next week is going to tell an awful lot. So if we do get a little bit of a bounce, we look at the 10-day moving average, we're just simply not that oversold on Apple. But if we can bounce from here a bit with some sort of a market bounce, at least give a little bit of a reprieve. But now, when Apple bounces to the upside, it's going to have some resistance here at 160. Can it get through that? It needs to continue back to the upside, but we're a ways from that. All right, looking at some of our other markets, the Dow has broken to new lows. We're not just testing them, we've broken to new lows. We even had a new closing low on the Dow. That's pretty significant. You take a look at the 10-day moving average, and we are also quite oversold by the 10-day moving average on the Dow as well. So maybe we get a little bit of a bounce, but looks like we're likely coming down to that wave 5 low, or at least that's a potential. So if we take this other stuff off, take the moving averages off, we do have a zigzag pattern here as well on the diamonds. And when you look at it, look where we are, dead on that 100% level, exactly there. Now, if we break below that, look where the 161.8% extension is on the Dow, right at the bottom of that wave 5 forecast. So the wave 5 is telling us that we're likely to break below this, but we're still in a wave 3 here. So we could bounce back up. Maybe we bounce back up far enough to even test this level at 310 and set a wave 4. But at this point in time, we're just looking at an oversold condition and a short-term bounce. Anything further than that, we'll have to evaluate it at that point in time. Looking at the Qs, also have their own zigzag, haven't quite made it to that June low yet either. If you look at the 10-day moving average here on the Qs, a little bit oversold. You can see the markets are all pretty much the same zigzag mania here with all of these patterns, but we haven't hit that 100% extension yet on the Qs like we have on the other markets. So it does look like we're going to come down and test those June lows at some point. Again, the question, do we bounce first? I think it's likely because we're so oversold. Looking at the Russell, here's another zigzag pattern. Look at that one, dead on its 100% extension. Gap down today. So I do think that we are setting up for bounce in all these markets, coming back up, filling that gap. How far back do we go? Do we come back to the 10-day moving average? Now, if you're new, if you haven't watched these videos before, one of my trading rules, there's rules and guidelines in trading, is that no security in any time frame gets very far away from the 10-day moving average. But it doesn't necessarily mean that you bounce back. One of two things happens. Either you bounce back up towards that 10-day moving average and close that gap, or the market, the security, whatever goes sideways and allows the 10-day moving average to catch up. I do think in this scenario the markets are so oversold, it's likely that we do have some sort of a bounce back to the upside, but how long is it going to be? I don't know, but 170 was the key there. You've heard me talking about this 170 level for so long on the IWM. We got to get back above that to have even any hope to move back to the upside. Looking at India, we talked about India numerous times and said that the market had looked so good with the fact that it had been holding this 43 level, but I'm mentioning that because of the vertical nature of this move that went from 40 to above 43, that if we couldn't hold above 43 on the INDA, the Nifty there, that we're going to probably come back down just as vertically. That's what happens when you have a vertical move to the upside. There's no support or resistance, however you want to view it, on the way back down, and you can see we're coming down just as fast as we went up. And so seeing the India market drop, which was the one bright spot in the global markets in my opinion, and so looks like we're probably coming down. We're at least going to get here to 41 and maybe even come down and test 40. If we look at Germany, you can see that we have a zigzag pattern there, a big gap to the downside there, and we look at the moving averages, also oversold with this gap. Also, the German market, the EWG, has its own zigzag pattern, and look where it is on the gap down, exactly at 100%. So does that help it to bounce back to the upside, back towards that 10-day moving average? That would fill this gap here and come back to a test or resistance area at 21, which was the low from June. So you can see some of the markets are just short of their June lows, some are right there, some are just below it, but all the markets are right in the area of the June lows. So I thought we'd take a look at gold as well. Gold's down, hitting the top of this wave 5 level right here. And we look at GLD. It has a zigzag pattern in it as well. And we're not quite to the 100% extension there, which happens to fall right in the middle of the wave 5 target area. So someday gold will catch a bid, but it looks like any sort of bid in the next few days would be short-lived because we need to come down and hit that 150 level now on the GLD. Last but certainly not least, Bitcoin. We looked at that. We talked about Ethereum and its merge and all that stuff in the TradeFinders, and then we've talked about this numerous times with Bitcoin. It does not want to give up that 20,000 level. Somebody's buying. It's got to be more than just MicroStrategy coming in and supporting it. It will not follow through. Every time we come down and break, get below 19,000 and look like we're going to just break, head down towards 16 or even lower on Bitcoin, buying comes in, and so now again we're trading just underneath the 20,000 level, trying to hold on. The longer we stay underneath this 20,000 level, the greater chance there is that we just drop. It's like fingernails hanging on a cliff. How long can you hold on before you just give up and fall? It's got to get back above 20,000 to have any hope of moving higher from here. Hope you have a great weekend. Look forward to talking to you again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.